what I've really been wanting to do is have a workshop where we hear about wealth.
I would love to know what feelings arise for you when I say the words 401k or 403b retirement.
Contributing to employee retirement is the single best way for an organization to address that racial wealth gap.
Hello, everyone out there. Thank you so much for joining us for this edition of LevelUp Co-ops. My name is Joel Mejia. I work with the ICA group, and we are a nonprofit consultancy that promotes employee ownership nationally. And we are part of the Worker Cooperative Business Development Initiative, WCBDI, where we are part of a group of service providers in the world of employee ownership here in New York City. And in growing worker co-ops, we create these workshops to help folks access information that could help their co-op grow. And what I've really been wanting to do is have a workshop where we hear about wealth, where we really dive a little bit deeper into what wealth building is, why co-ops are so important in the work of wealth building. And if you didn't know about Just Futures, that this be an opportunity to get to know this very interesting group of finance wizards, you know, folks that have learned the world, the game, some might call it, of finance, and want to turn the tables and help us who don't usually have access to that kind of knowledge for, for reasons that we can discuss at another time. But we do have access, and Just Futures is here to help us access this very important information.
To ground us, if you feel comfortable and if you're a place where you can, uh, take a moment and close your eyes and take a breath. And I would love to know what feelings arise for you when I say the words 401k or 403b retirement. What comes to mind for you? What do you feel in your body? Corporations, okay. Match, Thanks, Stephen. Planning, yeah. Very hard to find something that has felt value aligned for us and affordable. Wow, it's like I planted Kate in the audience. I didn't. Okay, so now take another moment, and I would love to hear what comes up for you when I ask, what are some activities or feelings you would like to enjoy when you retire? Vacations, yeah. Making art, love that. Sleeping in, yeah. Travel, got a +1 to sleeping in. Freedom to do nothing, and all of the above. Yes. So it's an interesting contrast, I think. The what we feel when we think about these technical terms, 401k, 403b, versus how we ideally can conceive of retirement. And And ultimately, at Just Futures, and I think you all would agree, is we want everyone to enjoy long-term financial security so that when they reach retirement, they can enjoy these things like sleeping in and vacation and travel. And so today, what you can expect to walk away with after this session is broadly, we're going to be talking about wealth gaps and how workplace retirement benefits can actually help alleviate some racial and gender wealth gaps that have been persistent for a long time. And if you have a current plan or if you're thinking about starting a plan, we are going to give you information to guide you in vetting a prospective plan administrator, and then how you can update your current plan if you have one to bring in more equitability. And we will make sure Joel receives these slides afterwards and he can distribute them to you. So feel free to free yourself of taking notes for now. And we'll also make sure you get our email addresses so that you can follow up with us if you want to. So I will quickly give you an overview of the agenda, and then I will pass it over to George to get us started. So today we're going to talk about who is Just Futures, what does retirement have to do with equity, how employers can help close wealth gaps. We'll talk about traditional finance and its history of extraction. Then we'll go into how Just Futures approaches retirement planning and how you can connect with Just Futures. And then hopefully at the end, we'll have some time to answer specific questions. Over to you, George.
We are a people of color owned investment advisory firm that is driven by and accountable to social justice values. We offer retirement plans like 401ks and 403bs, asset management for organizations who want their reserves or endowments managed in a values aligned way, and back office support for private impact funds. Our mission is to deliver financial solutions that support a just transition to a regenerative economy. If you aren't familiar with just transition, it's essentially a framework for moving away from economic practices that extract from people and planet and moving towards economic practices that support ecological and social well-being, democratized wealth, racial justice, and a whole lot more. Towards that end, we are partially owned by a group of nonprofits who organize around just transition. If you'd like to learn more about our unique ownership model, we're happy to answer questions. We'll have some time at the end to do exactly that. What does retirement have to do with equity? When we talk about equity and money in the workplace, that conversation is usually focused on salary. That's important to address, of course, but the racial wealth gap is 3 times larger than the racial income gap. And as you can see in the chart, if we continue with current trends, the racial wealth gap will widen further. Similarly, gender wealth gaps are greater than income ones. So this is where retirement comes in. More than 1/3 of US household wealth is held in the form of retirement assets. 1/3, that's huge. And a large part of why retirement savings are such a driver of household wealth is because of the power of compounding interest, or the additional earnings that come from your interest being reinvested over time. That's shown here by the darker blue, the blue bars at the top. As you can see, the majority of the gains come from that compounding effect. Those who have the means to invest and let their investments sit untouched get to benefit from those effects. This is really key. This reflects a one-time investment of a unit of money. 25 years later, it is over 10 times larger without contributing any new money, just from having the interest reinvested over time. So unsurprisingly, we see the same racial disparities when looking directly at median retirement savings as we do with wealth overall. So whose responsibility is it? Do we just tell people of color and women to save more for retirement? That would be the most American thing to do. Over the last 40 years, we've seen a shift from a collective responsibility to an individual one. Pensions and Social Security used to play a bigger role providing long-term financial security. With the rise in defined contribution plans, including 401k and 403bs, that responsibility has shifted to fall primarily on us, the individual, from deciding how much to save all the way down to selecting how to invest those retirement funds. Culturally as well, there is a widespread emphasis on financial literacy. Framing the problem as one of illiteracy places the onus or blame on the individual, rather than recognizing that we can take a collective approach to ensuring financial security. Just Futures released a report in 2022 that goes into more detail about how we can and should push for sector-wide solutions to move that responsibility back up the ladder. We'll share the link in our follow-up email to that report. But today, we're mostly going to focus at the organizational level. On that note, Chitra IR, who authored the report, recently shared on the Fund of the People podcast that contributing to employee retirement is the single best way for an organization to address that racial wealth gap.
Employers can help close these wealth gaps, George explained. And the question is it enough for employers to simply offer retirement benefits? No, it's not enough just to offer them. We want to talk about equitably distributing an employer's retirement benefits. And so there are 4 features that we highlight when we're working with employers, and I'm going to go through them one by one. The first is eligibility. Now, did you know that women work part-time at twice the rate that men do? What that means is if an employer is only offering benefits, retirement benefits to full-time workers, that's going to have a disproportionately negative effect on women. who are less likely then to access those benefits. So for that reason, we encourage workplace retirement plan providers to have eligibility be as universal as possible. We also encourage minimal service requirements. So, for example, you may have seen that an employer requires you to work there for maybe 6 months or a year before you can access benefits. And we encourage employers to minimize that gap and have the access to the benefits be available immediately if possible. Then there's enrollment. For a long time, the traditional model was what's called opt-in. So that meant that if if a worker wanted to access retirement benefits, they would have to go through some sort of process, often kind of an onerous process, to opt into the program. More and more in recent years, we've seen the trend to popularize automatic enrollment, which means that as soon as a worker becomes eligible for the benefits, automatically they are enrolled. And in fact, by law, for a new plan beginning on January 1 of next year or later, these plans will have to be automatic enrollment. What we see when automatic enrollment is in place is actually much higher rates of saving and investing from workers. One reason for this higher rate of participation is that especially people of color who are less likely to have learned about finance at home, if they are not sure whether it's even the right thing for them to do to put away money for retirement, and they have to go through a bunch of hoops to opt into the system, then they're less likely to use those benefits. So now, George, yes, okay. We see this big jump from auto enrollment versus opt-in, the big jump in participation. Now, let's talk about employer contributions. When I asked earlier, what does the retirement plan 401k, 403b bring up for you? Someone wrote in the chat, match. And in fact, match, an employer match, it sounds like a good idea in theory. What it means is an employer might choose to match up to, say, 4% of what the worker puts into their retirement account. But actually, what we see is this sort of setup can end up exacerbating wealth gaps. So here on the screen, you'll see an example. We have 4 staff people, and if the employer offers a 4% match, staff person 1, let's say they are contributing 8% of their paycheck into their retirement account. They are then receiving the full 4% employer match. Staff person 2 is contributing 4% of their paycheck, and the employer is also matching that full 4%. Staff person 3 is contributing only 2%, so they're only receiving a 2% match. And then there's staff person four who maybe because financially they're not in a position to contribute anything to their retirement plan, then they're not receiving any of the organizational benefits that are being offered. So you can see how that is unequally distributing the employer's resources. Instead, you can compare that to what we at Just Futures consider to be a more equitable policy, which is called a guaranteed contribution. And in that case, an employer might say, regardless of how much or whether or whether a worker contributes anything from their own paycheck, even if they contribute $0, we are going to calculate 4% of their salary. And then on top of what they normally get paid, we're going to put that 4% into a retirement investing account for them. And we're going to do that across the board. So you can see then on this new graph that even staff person four, who maybe is earning a lot less money than staff person one, they're still getting something put away for them toward their retirement. Now, some employers will take this even a step further in equitability, which we really love to see. And that's instead of doing a percentage, an employer could choose a flat dollar amount and apply that across the board to their staff. So again, if we look at this example on the right-hand side of the screen, we can imagine that maybe staff person one earns $200,000 a year, and maybe staff person four only earns $30,000 a year. Well, it would be more equitable if the employer said, we're going to allocate $2,000 to every staff member, and over the course of the year, we'll contribute that to each staff member's account instead of 4% of each individual staff person's salary. Because again, if staff person one is earning a lot more, then 4% of their salary is going to equal a lot more dollars than someone who earns less.
When you are seeing guaranteed contributions, is that looking like kind of a median salary would receive X amount at 4%, or based off of a high end of, how do you identify that guaranteed amount? If it's a flat dollar amount.
That is a great question that I will let George answer.
Yeah, I mean, the honest truth is that it's really budget related. So everybody has to look at their own organizational flexibility and set that. I mean, obviously a guarantee is a bigger contribution, let's call it, right, to commit to. And so that flexibility is the biggest piece.
It depends always, right?
Yeah, exactly. I mean, there's no like there's no like magic number. Obviously, what you're trying to do is to provide for your employees an equitable path to savings. Any number that is provided is certainly appreciated. Higher the better, right? But every organization will be different.
Let's talk about fees, another major factor. And the first question that we like to work through with our clients is, what fees are they paying anyways? Because actually a lot of financial intermediaries purposefully are not transparent about their fees, and they might present a plan that looks very affordable from an employer perspective, but that's only because They're actually taking the fees, deducting them directly from the worker's account. And so I'm going to bring up an example where a 1% difference in fees, because of the power of compounding interest over a long time, which is often what we're talking about when we're talking about investing for retirement. It's often maybe over 10, 20, 30, even 40 years. That 1% deduction in fees represents not only the 1%, but all of the gains that 1% would have accumulated through compounding interest over time. So here you'll see that the difference between 1 and 2% over 40 years can amount to about $70,000 difference of what an employee would have earned in their account. So if you all have plans and you want help understanding your fee structure, which might not be very transparent, feel free to reach out to George or to me. Again, we'll give our email addresses at the end, but I'll say them now too. They're our first name at justfutures.com. So for me, that's Lisa at justfutures.com. And for George, it's George at justfutures.com. And we would be happy to help you understand what fees you're paying. Yes, Simena. Maybe George can type our email addresses, but we'll also make sure to show them at the end of the presentation. Finally, I want to talk about one last factor, which is not a factor that a lot of our peers in this industry talk about, and that's the importance of having a financial advisor that staff can trust. So we know that people of color have historically been burned by the financial services industry, and for that reason, they're often quite risk averse when they invest. And because we're talking again about retirement investing over long time horizons, a risk averse strategy is often not the best way to go. So I'm going to show another graph that sort of mimics the one I showed before about fees, and this time it's going to show the difference between a strategy that's more aggressive versus a strategy that's more risk averse, and how over 40 years, again, because of the power of compounding interest, the person who is more comfortable with their financial advisor and trusts the idea of having a more aggressive long-term strategy could end up in a much better financial situation. And here we see the blue line at the bottom versus the red line at the top. There's a huge difference in what each of these people ends up with by the time they want to retire. And so having that trusted advisor who staff can feel comfortable with can help avoid the pitfalls of overly risk-averse strategies. And if you are setting up a new plan, the factors that I just talked about, eligibility, enrollment, fees, having a trusted advisor, and the employer contribution, these are all easier to set up from scratch. But if you already have a plan and the settings are not how you want them to be, they are adjustable too. So know that. In the broader society, you might not think about it often, but the financial services industry has a really big impact on our everyday lives. And Wall Street actually controls $43 trillion. They prioritize getting the highest returns, the highest financial returns for an investor class that is mainly white and male. And they do this at the expense of everyday people, communities, and our one planet. Additionally, the banking industry controls $23 trillion. And what this essentially means is wealthy people get even wealthier, and Wall Street professionals get paid very well to continue and entrench this system. So, what's the impact on us of all of this? I'm going to give some examples that are focused on equity, since that's the focus of this presentation today. We have seen many reports that detail how banks take advantage of borrowers who are people of color. This can be through redlining, through higher interest rates, worse loan terms, and higher fees. And where does the money go? Where do the bankers invest this money? It goes often to corporations who are polluting our neighborhoods, especially poor and working class neighborhoods of color. They can go to corporations who discriminate in the workplace. They can go to private prison operators and migrant detention center operators. So, what can we do to help rectify this bleak situation? At Just Futures, we have 2 phases of screening our investments. The first phase is the fiduciary phase. At Just Futures, we are a fiduciary, which means we are legally and ethically obligated to put our clients' interest as investors first. So that means when we're choosing which funds to offer to our clients, we first look at them from a traditional finance lens. And that means choosing funds that are top performing when it comes to factors like risk, return, cost, and risk-adjusted return. Again, we take seriously and prioritize first and foremost our clients' ability to eventually be able to retire with dignity. And that means that the money should be there for them when they retire. So once we have considered have narrowed down the funds to the top performing ones, after that, we do something that's quite different from our peers, which is we screen for values. And there are a couple of resources we use to help us screen for values. A big one is called Your Stake, and it lets us consider 79 values metrics, like a couple of the factors I mentioned already. So trying to weed out private prison operators, migrant detention center operators, fossil fuel companies that perpetuate the fossil fuel crisis, and companies who have unfair labor practices. The list goes on and on. And so we have these 79 metrics. And then on top of that, we survey our social movement partners to understand their priorities and minimize exposure to corporations who are doing those communities the most harm, which are working class and poor communities of color. And we screen on two levels. So there's the fund level, and here in this image, you'll see two funds. So there's BlackRock on the left, and there's Addisina Social Capital Fund on the right. And we screen to minimize exposure to extractive corporations. And then we also screen to minimize exposure to asset managers who have long histories of extractive behavior. So, for example, Vanguard, BlackRock, and Fidelity are three of the most powerful asset managers in the world. They each do have funds that are branded as sustainable, but overall, their investment practices are very extractive. So we categorically do not platform any of their funds. This majority action report shows just how much power Vanguard, BlackRock, and Fidelity as a block have. And what it means is that when they are voting on corporate policy at annual general meetings of large corporations, they are able to shape corporate policy in really big ways. And this report specifically shows how when other shareholders have put forth initiatives to hold corporations accountable to racial equity, Vanguard, BlackRock, and Fidelity have wielded so much financial power that they're able to strike down those initiatives for racial equity. So I will end by saying that when we choose where we put our investments, we are effectively voting with our dollars. And our power doesn't end there. We have collective power as shareholders that we can use. And the vision that we have at Just Futures is to unify our collective power and our collective wealth so that we can start shaping corporations, pushing them to be better, and use our voice as shareholders to build better communities and a brighter world.
Just Futures partners with a company called Vestwell, which you see on the right-hand side, to offer a turnkey retirement solution. We Just Futures, as the investment advisor, chooses the investments that are available and creates the models that most workers will invest through. We help support your thinking around plan design. And as Lisa shared some details around a little earlier in the presentation, right, give examples of how to do that equitably. We also provide employee training and advising. We do a 1-hour full staff training on what a retirement plan is, how to think about savings, how to enroll, all the things, soups to nuts. We also offer one-on-one advising slots to you and your staff in perpetuity, where each worker could ask questions in a safe space on things that are specific to them or topics about retirement savings in general. Vestwell is the plan administrator. They do the record keeping, compliance testing, reporting to the federal government, and they manage the online platform that both the administrators and savers use to manage their accounts. We chose them because they have, one, competitive pricing, but also that their platform itself is super user friendly, and they have an automated system to do all the compliance work that makes offering retirement plans much more time consuming. So it takes all of that work off of your plate. What you see on the screen now is a preview of what the portal looks like for savers. It's easy to see your overall savings, to update your contribution amount, or maybe your investment strategy, right? And see all the transactions involved in your account. Finally, I want to share briefly about what the onboarding process looks like. For new plans, it takes approximately 2 months to get up and running. For conversions, as you might imagine, because there's existing framework, it takes a little bit longer, about 3 months, to allow for coordination with your existing provider. The first step is to choose or confirm how you want your plan to look. So elements like eligibility and vesting periods. The onboarding itself is super easy inside the Vestwell system. They walk you through a series of steps to connect your bank account and upload an employee census, so everyone who's going to be involved in the retirement plan. And then depending on your payroll provider, Vestwell would either help you to directly integrate, which would be ideal, or will provide training on uploading your contribution files. And in most cases, that's it. It's really that easy. With conversion plans, sometimes we'll run into some complications with your old providers. But generally speaking, between us and Vestwell, we'll work through those challenges. To touch a little bit on pricing, we have a strong ethos around transparent pricing. Unfortunately, this industry hasn't done a good job in providing clarity around pricing. For us, you can find it on our website. The pricing will vary depending on a number of factors. But frankly, the easiest way to go about this and confirm all of that would be to set up a call with us, and we can talk you through each of the details. And so, quick shout out before I finish. We have a partnership with the U.S. Federation of Worker Cooperatives. And so now if you are a member, you'll receive discounted pricing. And with that, I'm going to open the floor to any questions that you might have. Yes.
Hi, Lisa. Hi, George. Thanks for the presentation. This was really helpful. On one of the slides, Lisa, you had shown that aggressive investing approach, which was like the 1.3 million versus the 370,000 a year with those different lines. I was curious in terms of like that graph with the red line, was that showing, a best case scenario? Was it showing an average? I guess I'm wondering of like, is there survivor bias there? And is there a recommended level of risk tolerance for more marginalized communities versus, or is this just like on a case by case basis?
Yeah, I mean, it's effectively a case-by-case basis, a demonstration, again, as the effect on the amount of risk within a portfolio. It's chiefly a mathematical exercise more than anything. Some of the, or not some of, the descriptive of what went into the calculation is there in the fine print. And we'll provide these slides so you'll have an opportunity to look at it for yourself. But what it demonstrates is the degree of risk, exposures to different asset classes within a managed portfolio presents a different level of opportunity for realized return. Everybody's risk tolerance is going to be different, right? And so ultimately, the decision on where a person lands in making those choices is a personal one. As I mentioned, we provide one-on-one sessions where we can help guide that thought process for each individual participant. But the general idea we like to relay to people is that retirement and saving for retirement is a long game. And the further you are from retirement, in other words, the younger you are, the more years you have before you retire, generally speaking, you can take on more risk. And taking on more risk implies a greater exposure to stocks, investment in corporations. Because the idea here is that any volatility that might happen in the short term will eventually be recouped, those losses, in the long run. Again, owing to the fact that you have many years in front of you. As the years go by, the idea is to shift that risk to be lower, which translates to a smaller allocation to stocks and a higher allocation to bonds. Again, these are topics that we go through in our participant education session and then make available through one-on-one conversations. Okay, thank you so much for joining. We're glad you were able to make the time, and certainly look forward to possible future conversations. Thanks for your question, Stephen. Did that cover things?
Yeah, that was great. Thanks.
Okay. All right, super.
Guess I can jump in with a quick question. See somebody's waiting. Submit term. Um, so I had an opportunity to talk to a financial advisor early on. Not early enough, but with enough time, to like really digest what was really going on. And I
Mhm.
found it really useful that it felt like a therapy session almost, this initial goal setting
Yeah,
process, right? Like I'm a visionary thinker already. So it wasn't really that difficult for me to go, okay, what do I see in 20 years? What do I see even in 30? Go a little further than just like the 2 year or 1 year or 5 year thing. So
sure.
I'm curious because I feel like that's something that I tell the members of my co. What do you see for your life? Like, yeah, it's fun to think about vacations and sleeping in, and that was a wonderful exercise, Lisa. But I think like that's right, that's the deeper part of all of this that I don't think you really gone into. So would you mind maybe sharing some experiences that you've had, whether or not you've had to like maybe tell people like you need to dream a little bigger. Like, do you talk to people like that? You know what I mean? Is that appropriate for you? You know what I mean? Just
Yeah,
curious
yeah.
about that part of it.
No, I hear you. It's the human aspect. Um, as we alluded to in during the conversation, this topic, finance, investing, savings for retirement, is scary. It can be intimidating. It's filled with concepts and terms that are not familiar. Money as a topic for many people can, again, be intimidating, but also be traumatic. We all have our own lived experience and relationship with money, and how we navigate that and reconcile that is a personal journey. So what you described is one, I'll call it one step of the humanity of it, right? The outcome that you want to see happen. Um, and then what you can do in working with an advisor or have conversations with around the topic of investing, it's a little bit of a release, and it also connects the dots to those more, again, human outcomes that you want to realize. I want to be, I want to have the freedom of mind to be able to sleep in retirement because I know I have dutifully saved over the course of years to be in that position. And what a conversation with an advisor or someone on our staff, if you work with us, can do is connect those dots. How can we get to that reality? What is if this speaks more to the individual? What is the math that gets us there? What are the realistic aspects to that kind of thinking? When you're just left alone to your own thoughts that you don't have maybe the ability to connect the dots because you're not familiar with investing and how the various risks come to bear, it can be a lot more difficult. But what I suspect that you experience in having that conversation, it formed a foundation and grounding for the possibilities, and then from there, you can create that reality.
So thoughtful, George. Thank you. And as a follow-up on the flip side, right? As a member that would be receiving this benefit that also has to make a business decision now as
Yeah.
well, because I think we can see how we can align values, but it's still in some cases a business decision to
Mhm.
offer this benefit. What advice would you give owners that have never had to think about this,
Yeah.
and that this is really like you said, uncomfortable in
Yeah.
different ways?
Yeah. 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 I mean, I think you can think of it as you might think of any benefit that you provide to your employees. There's an array of these types of employee benefits that are part of that decision making. And what it comes down to, you know, finance, financial wellness is alongside other things that like health wellness. It is a benefit. It helps attract talent, right, by offering competitive benefits. Of course, we believe the values aligned benefit is of particular attraction to those like-minded folks like us that see the world differently. Um, and it helps retain talent, right? Because you're providing ideally an equitable resource, financial benefit that is not typically found elsewhere. Rebecca,
Oh yeah, come on. I'm sorry, I'm off camera. It's just that kind of day.
no
Um,
worries.
that's okay. I was late, so you may have said this, and I really appreciate Joel's question because it kind of lines up mine. For the very small companies that I support in their formation as co-ops,
Yeah.
they're looking at their their balance sheet, their budget for the next year, et cetera, and claim ideally that co-ops build wealth. And this is, I think, part of that wealth building strategy, not
Sure.
just counting on profits in the business that you
Mhm.
might get annually or when you exit, and not just pay, which you might get as you work, of course, but also, a saving strategy. So I think it's important to include it as sort of in one's budget or in the declaration of how you want this company to grow, as we want to provide these benefits. But then it goes into what's the cost for the company or
Yeah.
for the individual. So I think I saw a slide that said like 3,700 a year or something for a person would grow on that chart you put up towards the end.
Mhm.
I'm curious if we were to think about it with small companies, what kind of dollars should they think about either encouraging workers slash members to contribute out of their own dollar or to put on the budget as coming, out of the budget, which might look like an employer contribution. So it's a combination of employer contribution and personal contribution. But since the workers are the owners, I think they might want to consider it all together in the budget. What kind of numbers should we be looking at?
Yeah. Okay. So everyone loves rule of thumb. And so I'll express it in that way. Everyone's situation is different, how much they can contribute. But in ideal terms, what a person should be trying to aim for in total is somewhere between 12 and 15% of your income. And so the sources of that could be, again, what you're personally putting towards that in your personal contribution, the match or guaranteed contribution that the employer might provide as well. You want to try to have that be within that range, 10, 12, 15%. And the idea over time is that the accumulation of that targeted range, when you reach retirement, you'll have accumulated a level and grown a level of savings that will maintain, roughly speaking, that same cost of living, quality of life that you were supporting with that level of income.
Okay, that's very helpful.
Uh,
So 12 to 15% of your current earnings
Correct.
would be what you'd look at to maintain that post-retirement experience in,
Exactly. I
in a
mean,
return.
it's a rule of thumb across the gamut of ages. Obviously, if you're a little bit older and maybe perhaps haven't kept up to that, that number might not reach that. But generally speaking, over the course of time, if you are aiming to hit that range, you will be the better for it.
Okay. Leaves me things to think about. Thank you.
Yeah, sure. Stephen.
Hi again. Uh, Building off of what Rebecca was just talking about, I'm actually curious in terms of, when also from the worker co-op space, when you're viewing it from a budgeting perspective and, let's say it's the match. I'm not saying it's a standard, but I've seen a lot of those like 4% match as like that's the number that I've typically seen. But when it's the match, from a budgeting perspective, I know not all employers are thinking it's going to be used 100%. So they're almost budgeting like, 80% of that will be used across employees. When it comes to the guarantee instead, have you seen or do you also recommend still that like 4% target to stay competitive? Or is it like because it's guaranteed and it's going to go to all employees, is it more like 2%, 3%? Like what's the recommendation versus what you see working?
Yeah, yeah. And that harkens back to the earlier question around this. I mean, obviously, if it's a guarantee, the math is almost easy, right? It's easier than trying to estimate how much the worker base is going to access this. But I think your framing is exactly right, right? It's about the competitiveness of the benefit. And so most plans will fall in that 3%, 4% range, whether they're doing a guarantee or not. So those who are doing the match, generally speaking, will fall in that range. Some will go richer than that, but the 3% and 4% is where the center of gravity, if you will, is for that benefit. And part of the reason why is this concept that's referred to as a safe harbor, which is sort of the minimum requirement to navigate some of compliance requirements, which is why the 3 to 4% is where things fall. So, I mean, the shorter answer to what you're asking is yes, you can and should think of it in terms of that competitive rate as well. 3% for a guarantee is generally where things land. 3 to 4% overall is where most of the gravity is. But again, your financial situation will support a certain amount, and if it comes down to, as you put it, offering 2%, which would be less than that, um, the general spot where that match is landing, you balance that against the equitable aspect of what you're offering, which is not insignificant.
Makes sense. Thank you.
Okay.
I have two like technical questions. First, are owners treated differently than other employees for any of these plans?
The idea, actually, the rules around retirement are designed to not have that be the case. And there's testing that is required to demonstrate that owners are not inequitably benefiting from a retirement plan. I just made mention to the that safe harbor concept, where you have built-in contributions, rules around the contributions and the amount and size of it that allow for a navigation of those equitability rules. Because there's, by definition, there isn't a disproportionate benefit on one class of employee versus another.
Yeah, I think my headspace was thinking about taxes and that, for income taxes, that difference between employees and employers, but that totally makes sense. Uh, and then I guess this is kind of in line with the last couple of questions. I'm curious if you can share like what has been maybe the smallest business that you've worked with, or like on the very small end, like what is a gross budget looking like for an organization that's like just barely making it to be able to have retirement benefits offered.
Yeah, yeah. I mean, we have clients with us, little as one employee. But generally speaking, right? I mean, we don't have a minimum, and the challenge ultimately for those organizations that are smaller, right? It's just like any budgeting challenge. There are fixed costs that, regardless of the size of your organization and number of employees, that have to be part of the equation. And so, and if you're interested, we can get into the details, maybe have a separate conversation. But the way to think about it is from a administrative perspective, and remember our partner is that organization we mentioned, Vestwell. They do the reporting to the federal government, the record keeping, and provide the platform. That's what that fixed cost supports. So that is in the range of, depending on your situation, $160 per month for the organization. And then there is a per participant cost, which can be $7 or $8 a month for the individual, right? So each individual participant would drive that particular cost. Does that make sense? Does that help?
Yeah, and the additional percentage fees, is that something that is taken out that you're paying for
Mhm.
on that monthly basis, or is it at the point, at what point is that charged?
Yeah, so the percentage fees, there are two that we like to lift up. So Just Futures as an organization, we're compensated on that basis. And that'll range depending on a number of factors, and that is charged on a quarterly basis. And then there is a fund charge. This one is not typically referred to commonly by other providers, but we like to lift it up in the spirit of transparency. So the term is mutual fund or exchange traded funds. If you're familiar with the term, these are the actual vehicles that savers are putting their money into. There is a charge at the fund level that doesn't go to us, doesn't go to Vestwell. it's baked into the value of the fund itself, that is an additional charge, and generally that's expressed as a percent of the amount invested. As a reference point, that ranges for us and the funds that we use in our plans between 0.20% and 0.24%. And maybe in simpler terms, the way to think about that, for every $10,000 invested throughout a year, that would be $20. The 0.20 translates to $20 of fees each year.
And so the payment that we would be seeing like being made out is that flat 160 or whatever the other tier is, and then those other fees are just being taken out of what we are contributing, or does that make sense?
Yes, it does. It does. And so that it's effectively taken out the fees that Vestwell will charge.
Yep.
That's at the plan sponsor level. So it's kind of think of it as an invoice. You charge that. The amounts that are specific to the dollar amount invested, that happens quarterly. And you would see that at the account level, depending upon who's paying it. So what do I mean by that? With our plans, for that participant per participant administrative costs that I mentioned, the $7 or $8, there's an option for the plan sponsor to pay it, in which case the plan sponsor would just simply get invoiced, or the participant could pay that, in which case you would see that at the participant account level on a quarterly basis.
That's really helpful. So sorry for anybody else that was like, why are we getting this into the weeds in this conversation? But I appreciate your very detailed response.
Okay, awesome. I mean, yeah. I mean, the deeper you go in the weeds, sometimes it's hard to get through it. But I appreciate the question. And again, if anybody wants to explore this for each of your respective organizations, please do reach out. We're happy to make clearer sense of the cost. If you have an existing plan, make a clearer sense of what you're paying. You might, or maybe you wouldn't be surprised that a lot of organizations don't have a clear view for that. And in the process of approaching us, we help bring clarity to that so they can make an informed choice, budgeting choice for their organization.
I want to give thanks for Lisa and George. I want to give thanks for the whole Just Futures team. You guys are incredible. And I also want to give thanks for everyone who chose to show up to this. And for those who didn't, you might be watching this on YouTube right now. So I thank you if you've gotten to this part of the YouTube video. That means you watched it all. So good job. Nice job getting to the end.